Hi, this is the market outlook for the week from 25th to early March. Nothing has really changed from last week. We're still in a very bullish mode, lots of momentum. And as you can see on this chart, I have actually reduced the width of bars to actually show more history. And we see that I could actually go further to see that this type of unstable rise is very similar in terms of gradient to the one we had in January last year. As a matter of fact, this one, of course, close to all-time highs, was calling for some profit taking, and it went very deep, losing about 600 points in the fourth quarter last year. But overall, a rise in a acceptable gradient is usually more stable. There's actually an optimum angle, which we call actually the natural angle of ascent or descent. So this is why when the market falls so sharply, it calls for a bounce. And here we see that this rise is unstable. This rise definitely will call at some point for a profit taking that could be actually pretty violent. But if we now look just for the coming week, I've said in my notes last week that we are into a bullish congestion mode. That's still the case. If we look at a 1 hour chart, we are now more or less on the stall level I mentioned last week, close to 26.90, 92, where it closed actually on Friday. Buyers may want to just go for the 28.10, 28.20 strong resistance. It's difficult to say. If we then have some profit taking, it is likely to be stopped around 27.35, 27.50. I could plot a fib pattern here, would probably show a similar picture. We have a strong support on mid 2700s, 27.50, and then 27.40, 27.50. So there are lots of support levels that will prevent, at least initially, a strong reversal. So in case the market then congests in between the stall level 27.90 and the strong resistance, we may then have a first profit taking that could take to one of those levels, let's say 27.50, and the market will most probably, because of the buy in the dip type of attitude, go for a head and shoulder or double top. So we'll see. In case the market then breaks 28.10, 28.20, although a pause would be definitely sensible. So if it breaks for any exogenous reasons or external source, that, I don't know, trade talks, then the market could actually go right up to the all-time highs. I don't have a clear view of a resistance level before we go to the 2900s. The market is obviously very much overbought, but it could rise further. I have now plotted a fib expansion pattern where it paused around 26.25, first reached a resistance around 27.50. And we see that we have a first target in 28.06, 28.10. So I believe momentum is strong. We have a sell signal that needs, or at least a sell alert that needs some confirmation. But yes, most traders go by the motto, the trend is our friend. So we should refrain from being too contrarian and just accept that the momentum is still pretty strong. So if we go along that way, we see that we have a strong resistance array around this again. And if we then look at a possible then resistance area, it would be very close to 2900. And as you can see, an almighty 3000, probably sometime later in the year. But that's too far. So again, at this time, the gradient is a bit too strong to be stable. I would think that although in the hourly chart, this range is bound to break. We've had a congestion in the same range for a few days. From the 19th to the 22nd, we hovered between 27.50 and 27.90. This has to break. So the market could go up, but then I would say there will be new energy coming. The momentum is telling me that it should try and go higher, but at the same time, we can't discard a scenario where it would actually go back to the support I mentioned earlier. Okay, so that's it for this market outlook. For the next few days, I would say bullish congestion, and unless there's something to really break this balance of power, the market should actually then try and go for the 27.50 area. In the next video that will be posted as unlisted or private, I will then look at how it affects our current positions, which are not doing too badly, at least in comparison to many other market neutral strategies.